And our next speaker is the co-founder and president of Seedrs. Warm welcome to Carlos Silva. Carlos, good to have Seedrs back on Webit stage.
Thank you. It's a pleasure to be
here
here.
You are. You're always welcome, and this is your clicker. So I will be happy to hear next. Thanks.
Thank you. Well, good morning, everyone. It's a pleasure to be here. Thank you for coming. So I'm going to kind of tell you a story. And I'm going to start by talking a little bit about ancient history. That's kind of a good way to start because we're in a city with so much history, a city that had a number of names through history, and that was the center of the world at a point in time. So history is everywhere around us, and that's what I want to talk about a little bit. And the ancient history that I want to talk about is about proprietary deal flow. Proprietary deal flow deals with number of individuals or companies having access to a number of deals that no one else has access to. It's about access, and it's about restricting that access as much as possible because that has value. And what we've seen in the past is that, and if we continue to look at that trend, what we're seeing is that that proprietary deal flow, that access to specific deals that only a few get to access, is slowly dying, and it's slowly disappearing. It started about 100 years ago with the stock market. Nowadays, we take as granted the ability to invest in companies like Google and IBM and Apple and BP and Exxon. But go back 100 years, and that wasn't the case. Access to those sorts of companies and the ability to invest in those companies was restricted only to a few. And that changed, and today we see that as something normal and very acceptable. But there are still a number of investments that are restricted only to a few with the right connections, with the right amount of money, and in the right place. And that's kind of what the fintech revolution, and more specifically crowdfunding, is trying to tackle, and it's trying to disrupt. And it's not about changing something or breaking down barriers that haven't been broken before. It's just about the continuation of that kind of opening of those markets that started 100 years ago. So what exactly are we talking about? If you look at startup companies, for instance, so early stage companies, that kind of investment is still restricted to a few. And traditionally, it has been restricted to a few for the last 40 or 50 years. Not much has changed in that industry. What crowdfunding, and more specifically equity crowdfunding, allows is for anyone to invest in those businesses. And at the same time, it allows those businesses to raise money from anyone instead of just a few. It's a model that was first thought of looking at entrepreneurs. Because at the end of the day, if you're an entrepreneur and you're starting your business, the way to go about raising money hasn't changed much in the last years, as I said. You have to either have some rich family member or rich friends, or to be connected to business angels, or to be able to raise money from venture capital firms. And while that may seem accessible and easy if you live in the Valley, or if you live in London or Berlin, that's not necessarily as easy if you live somewhere else. And in a number of places, what you do have are very successful entrepreneurs, businesses that can go a long way, but where capital isn't as easily accessible. And yes, they can get on a plane and go somewhere else, but they're always at a disadvantage because they don't have the right connections, they're not in the loop. So in a way, that has been traditionally not an easy thing to do. And with equity crowdfunding, what we're basically doing is allowing more transparency and greater efficiency in the market, and allowing them to raise money from other kinds of people. Because looking at the investor side, this has been a very closed market as well. Let's just think about what you need to do to be a successful business angel. So if you want to be a business angel, what you're thinking about and what you should be thinking about is investing in at least 20 or 30 companies. If your target is to invest in less than 20 or 30 companies, you're not being a business angel, you're gambling. Because the odds of you getting one or two winners that will eventually pay for the rest of the investments are very, very slim. So you have to make 20 or 30 investments. However, each investment and each transaction involves a significant time of due diligence, involves legal support, involves negotiating contracts. So the cost for each transition implies that as a business angel, it doesn't make sense to invest less than 20 or 30K per investment. So if you're thinking about 20 investments at 20K per investment, we're talking about 400K. And if you think that these kinds of investments, you should only dedicate 5 to 10% of your net asset, what we're basically saying is that unless you have 4 to 8 million of net assets, you can't be a business angel, or at least a successful business angel. It becomes very difficult to do so. So this is restricted to 0.1% of the population. Does it have to be that way? No, because when you're investing at a very early stage, transactions should be simple, should be quick, efficient, and inexpensive. And in a way, that's what equity crowdfunding is doing. So, in thinking about all of these changes through time, one thing always comes to mind. It's about businesses killing the middleman. It's about the middleman disappearing and dying and getting people together in a much better way. But actually, is the equity crowdfunding revolution killing the middleman? Well, actually what people are looking for is, number one, convenience. Both entrepreneurs and investors want a more convenient way to invest and raise money. They don't want, as an entrepreneur, they don't want to be knocking on every door, flying around, trying to find investors, when we live in a world with Facebooks and WhatsApps and all these communication mediums where I can talk with someone in China right here, right now, and I still have to fly everywhere to knock on an investor's door. So convenience is key. Also, agility. Because at the end of the day, I want to be able, both as an entrepreneur and as an investor, I want to be able to quickly adapt to changing circumstances. But in order to do so, I have to have a way to invest that is flexible enough to allow me to do so. And last, but certainly not least, comes efficiency. Because if I'm not investing in an efficient manner, I will not be able to diversify my investment and invest in the 20 or 30 or 40 or 50 companies that I need to do so in order to have a successful portfolio. But on the other hand, as an entrepreneur, and we've raised multiple rounds of financing, we know that one of the most painful processes that you have to go through is actually raising money. And it's one of the most painful processes because not only is it difficult, regardless of how successful the business is, but it's also time-consuming, and more important than that, it's focus-consuming. Because the time that you spend raising money, and as you move later into the stage of the business, that tends to be more time. The time that you spend raising money is time that you're not focusing on your business. It's time that you're not focusing on your clients. It's time that you're not focusing on your users. And at the end of the day, that's bad for the business. Yes, you need the money, and that's why you do it. But it detracts you from focusing on what really matters, growing your business, getting your clients. So the more efficient this process is, the better it is for your business. So, in reality, are we talking about killing the middleman? Is that really what we're talking about? Because we're connecting with investors directly with companies and startups and businesses. But actually, what we're doing is, while on one end creating a more efficient middleman, but also forcing the middleman to adapt to these circumstances. We're forcing the middleman to be more convenient, more agile, and more efficient. And what's the middleman in the traditional model? Well, the middleman is usually the VC, the venture capital firm, because the VC is the one that gathers investors' money and then applies it in startups and early-stage businesses. So are we saying that the venture capital industry is going to die? Not at all. I truly don't believe that. That is something that was discussed quite a lot 2 or 3 years ago when we started. And in a way, it was thought that equity crowdfunding would kill the venture capital industry. But it's not. Equity crowdfunding is a means, it's a platform, it's a new way of doing things. But that doesn't force the existing players to disappear. It just forces them to adapt. And if you're talking about venture capital firms, you're usually talking about two different things. On one end, what a venture capital firm sells to their investors is access to investment, is proprietary deal flow, is the ability to access certain deals that only them can access, and you as an individual can't. On the other end, what it's selling is the ability to pick the winners, to pick the ones that can really be successful in the future, and to manage that investment in order to ensure that the odds of those businesses being successful is maximized. And that's the two things that venture capital firms do. And they charge for that. They charge quite well for that. They charge 20% carry usually and 2% management fees. So it's not cheap. Is it worth it? Well, only a small fraction of venture capital firms ends up returning returns to their investors. But if you get those kinds of investments, then it's definitely worth it. So how is that market and that industry is going to change with not only equity crowdfunding, but much more efficient ways of investing? Well, I think that paying for proprietary deal flow is going to eventually end. Because with this new way of accessing these businesses, the market becomes a lot more transparent and a lot more available to everyone. So the venture capital firms that only focus on giving you proprietary deal flow and really are not that good at picking winners and are not that good at adding value to the business will eventually perish. But that's part of life. The ones that will succeed and eventually become even more profitable than they are now are the ones that really are good at picking the winners, the ones that really add value to the business afterwards. So what we're talking about is not necessarily a revolution. We're not killing the existing players and replacing them by new ones. What we're talking about is a democratization, is allowing the current players to be more efficient in what they already do, to do it in a more transparent way, but by doing so, opening up the asset class to a number of people that were previously restricted from investing in these kinds of businesses and will now be able to do so. We're allowing the masses, the ones that are not part of that 0.1%, to be able to invest in the next Facebook, in the next Google, or in the next failures. But at the end of the day, it's about choice, and it's about the ability to make those decisions. So we believe in a future where investing in startups is as simple and as straightforward as buying a book on Amazon or as buying Apple shares is nowadays. That's how we see the future, and that's where we believe it's heading to. Thank you very much. As I said, it was a pleasure to be here with you today.